If we have to do a standard lot on Euro USD, $1,000 is our requirement. When this requirement of mine is not fulfilled, then my $1,000 will start depleting. If my position is going into loss, I will receive a message from the broker. That will be the margin call. What the margin call will be is that your minimum required balance, which was needed to keep that trade in play, was $1,000 from you. Now, whatever position of yours is going into minus, and for example, you have gone $800 into minus, then the broker will start telling you beforehand. Depending on the broker, now what is the access? The access that the broker has, they might wait until zero margin. They might not give you a margin call, or they might warn you, but they don't close your position until your balance touches zero. But the rest. Excel brokers, what they do is if your margin, for example, $1,000 required margin to keep the trade, what will it do? When your $1,000 come down to 500, it will automatically close the trade. It will say that your margin reason is over. How can you avoid a margin call? And when a margin call occurs and your broker closes the trade, we call it a stop out. That stop out is achieved. Now, how to avoid a stop out? We have to avoid this by setting a stop loss and maintaining free margin with scalping trades. Keep the lot size small. Do not be greedy. Do not get into the grid. Always manage your risk. Never think that this cannot happen. It will definitely happen. It is 100% confirmed trade. When you think automatically if you do not set a stop loss, if you say it has to go up, after one trade, then another trade, then a third trade, you keep placing them in the same direction. So you have to manage all this. So now we will discuss types of analysis. We understood the foreign market structure. What is it? Which countries are there? Which country affects it? Who is doing Forex? From where? At what time does the market open, close? At what time is the market active, inactive? How many types of market orders are there? What is leverage? What is bid ask? What is a spread? How do we calculate it? How to determine it? How to convert the value into dollars? After discussing all these things, now we have to trade based on analysis. Trading without analysis is equivalent to gambling. Trading without management is gambling, which we call gambling. If you want to gamble, the best way is to go to 1xBet or any xBet. There are many betting applications available. Go to them. Go there and place a bet on a cricket match or an election and make money. The purpose here is not to bet. If you gamble here, you will incur more losses. There, you might still save some money. So that's why it's important to understand that trading is not without analysis. What is analysis? There are three types of analysis. One analysis is done directly by looking at charts. What are charts? Real life data that is making our decisions is shown in candles or charts. When we make decisions based on that data, it is called technical analysis. The second one we have is fundamental analysis. Fundamental analysis. Decisions are made by looking at economic factors, the country's economy, and Mahesh to determine that if the country's conditions are good, its currency will also perform well. If the country's conditions are bad, then its currency will underperform. So what do we have next? Market sentiment, market mood. What is market mood? What is the market doing? What are all the retail traders doing and how do we use that? What positions have people opened? So we continue discussing this. First, we have fundamental analysis. We will also discuss fundamental analysis a little in the coming chapters. We will go into its details and explanation. Basically, the indicators used for fundamental analysis are GDP. If the gross domestic product, GDP, of a country is doing well, its production is good, then obviously its currency should be strong. After that, there is the employment data. If the GDP is good, then how is the employment? Do people have jobs or are they sitting unemployed? If there is more employment there, then the conditions of the country are also good. And third is inflation. What we call inflation is gauged to see if it is low or high. If inflation is high, then the economy is going too fast and needs to stop. It needs to be slowed down a bit. It needs to be brought into balance. If inflation is very low and the country is suffering from deflation, then the economy needs a boost to speed it up. If the GDP economy is weak and inflation is high, then a country is suffering from stagflation and should be managed accordingly. So, we check these economic indicators for fundamental analysis. And then, what do we check in this, Mujib? The central bank's policy and the interest rate they set on deposits they determine. Now, if the interest rate is increased, what effect does it have on the currency? For example, if someone has bought swaps or dollar bonds for yields, they hold them, and the dollar's interest rate is 4.5, then they get 4.5% annually. The return on holding will come, and if a country's interest rate, like the yen's right now, is 0 or negative, then holding that currency will yield no return at all. So what will happen is that the currency's attraction will diminish, and obviously the dollar, which is giving an annual return, everyone will buy it. When that currency is bought, its demand will increase and the currency will automatically rise. As long as its supply is not increased, the currency kept rising. Then the second factor is political and global events. Whether it's an election or election results, the trade policy made by the election winners impacts the country and it matters. Additionally, if there is a war, a disaster, or an event like an alliance forming or breaking or a rebellion occurring, all these things affect the country's economy. Now, what do we have to do with these things in trading? In trading, we look at them and create a long-term picture. Like if this kind of policy happens, if this kind of situation arises, if this starts improving, then in 1 year, 2 years, 3 years, its condition will get better. When the condition of a currency improves into Australia, its currency will also become strong. So it will be perfect for us. So we understand it as a long-term picture or for long-term investment. Fundamental analysis is used for long-term currency holding.